What's up guys, Jake here, welcome back to another video. Today we're going to do an update to my brokerage account challenge. In the event you haven't seen any of my prior videos, I will include the entire playlist down below so you can catch up. But basically it's me versus a total stock market index fund. I started this trading challenge on January 1st. It is currently March 29th as of the positions of this video. This is trading day 59 of 252 for the year. And the S&P just cannot break that 4,000 point barrier. So it's been a little over 1 year now since the pandemic bottomed out the markets in March of last year. And I thought we would have hit 4,000 probably a little over a month ago, but we're getting close. 3,971 isn't bad. The total stock market index fund is up $1.88 since it started at $25, so it's up a respectable 7.52% on the year, and I am up 47.21%. Yes, that is correct. I started on January 1st with exactly $25,000, and as of today, I am up 11,803. I'm doing pretty well, and it's once I figured out options and call contracts, it's just so much more efficient in my opinion. I wanted to start this challenge by swing trading S&P 500 stocks, so jumping in and out to capture 3 to 5% gains. But when you leverage your money by buying call contracts, if you're right on that 3 to 5% movement in the stock price, you can earn way more by just buying a call contract. So these are my positions as of my last update video from March 25th. You can pause the video if you want to compare or see how they've changed. And these are my positions as of March 29th. So I'm still, as of right now, I'm only holding actual stock in Apple. And I have 38 shares in addition to a call contract, which is currently down 13%. But all my other call contracts are pretty much up. And all in all, I have 13 open positions with call contracts, and they're mostly financial and industrial stocks. I sold out my positions in 3 stocks that I was holding: Costco, Walmart, and Johnson & Johnson, and I just wanted to get rid of them. I don't actually want to hold stock anymore. And Costco, I was buying the dip as it was dipping in February, and it kept going down. So I was holding this a couple weeks until I got back above my cost basis, so only a $41 profit. Same thing with Walmart. As it was dipping, I kept buying it, and thankfully it has gone back above my cost basis, so I sold for an $18 profit. But I now own call contracts on Costco and Walmart. I still think they're good. I still think they're going up. I don't want to hold the stock, but I do want to capture the price movement with call contracts. And with Johnson & Johnson, I bought this because this was a vaccine play. I was expecting a bit more of a jump or a boost for their vaccine rollout, which was going really well, but the stock price didn't really move, so I'm just happy to get above my cost basis and free up that capital. I sold to close 2 call contracts, and this was for Verizon and the Hartford Financial Group. So with Verizon, I like this stock, but it's just not moving. It's been trading nearly sideways for over a month now. So it's just one more position that I don't want to think about, worry about, or watch. So I sold just above my cost basis for a $3 profit. And with the Hartford Financial Group, this is not a typo. I bought this call contract, I bought to open for $185. And I sold to close for $1,369. That is a 630% profit on my position. So when you look at the stock chart, I bought a call contract maybe right here. It then shot up 10% in 1 day. Now, if you ever enter a position and your stock shoots up 10% in 1 day, you should definitely go to Google News and figure out why. This is not a micro cap stock. This is like a Fortune 500 company. So I went to Google News, and apparently the Hartford, somebody's trying to buy them out. An insurance company, Chubb's, offered Hartford $23 billion to purchase their company. Now, I don't know what a stock buyout would do to the stock price, but apparently other investors on this news thought this was a good time to jump in. hoping that they'd get a good price because HIG would be delisted if Chubb's were to acquire them. I don't know how this will affect the stock price in the near future. It's already started to sort of turn back down. I mean, Hartford rejected the offer, but anytime a stock gaps up so dramatically in one day, over the next couple days or weeks, it has a tendency to gap back down and go back towards its natural progression upwards. This is still an upward trending stock. It's still a good stock to hold, but I might as well capture that 600% profit. And if I want to get back in this, I can do so after it comes back down at least to the 20-day moving average. So these are all of my positions and sales since the beginning of this challenge on January 1st. With all of my stock swings, I'm only up $2,200, but with my option trades, I'm up $3,500. In addition, I've got over $6,000 probably worth of unrealized gains. So if you go back to, I've got $5,700 of unrealized gains in the current call contracts and positions. So this rotation that I was talking about in the last two videos is still occurring, from tech and growth stocks into cyclical and value stocks. And investors are heavily going after the industrials right now. The banks and the financials as well, but I think the real value right now, if you're looking to buy certain stocks, is with the industrials. And an advantage here is there just aren't that many of them. You know, you've got Caterpillar, 3M, those are the big market cap size ones, but these are not very large companies compared to the tech sector. It's very easy to sell off a small percentage of your tech stocks and then buy a large percentage by market cap of the industrial stocks. So this is going to greatly, I think, pump up the value of the industrials. And the subgroup of the industrials that is lagging behind the other major industrial stocks are the defense stocks. Because of the election and Democrats getting elected, these were lagging behind as the other industrials already started uptrending last December, basically. So I feel like, you can buy Caterpillar, you can buy 3M. They're currently uptrending. They're good stocks. But it would have been better to buy those in December or January. So I'm looking at these four defense contractors especially because I love their fundamentals and their technicals look good, and they've been lagging behind. Investors are just now saying, hey, these haven't gone up in value. Everything else is starting to look overpriced. We want to buy these stocks now. In my last couple of videos, I already told you that I have call contracts on General Dynamics and Huntington Ingalls, but as of this video, I've added two more call contracts for Northrop Grumman and Lockheed Martin. So let's just do a recap of these four in general, since they're all starting to uptrend. But Huntington was valued close to $275 a share prior to the pandemic. It fell off a cliff, it never recovered, and it's just now uptrending. So this potentially could make it back to its pre-pandemic levels of $275, or maybe around here. I don't know. They do stock buybacks, and they're increasing their profits every year. But if this made it back to $275, and I have a call contract in Huntington, if I hold that, that's like a $7,500 gain, $7,000 just off this one call contract I bought. Here's their stock chart. Their 20, their 50, their 100, and their 200 are lining up perfectly. It's in a breakout. Short-term, mid-term, long-term, everything is bullish on Huntington Ingalls right now. The next company is General Dynamics. They make the F-16. And this has almost made it back to where it was pre-pandemic, valued around $185, $190. However, this company was valued over $200 back in 2018. I'd argue it was overvalued back then, but once again, this company does stock buybacks. They're increasing their profits. This easily could make it back to $200 effortlessly, in my opinion. So once again, holding a call contract, if it goes up another $20 a share, that's $2,000. I'm not going to say no to that. When you look at their stock chart, it's just perfect. The 20, the 50, the 100, and the 200 lining up perfectly. And yeah, it goes up and then it pulls back. It goes up, it pulls back. But what you want to look for is this staircase pattern of higher highs as it goes up and higher lows as it goes up. It's this stepping pattern which shows that it's in a perfect breakout, and it's probably going to keep going up in the near future. The next defense contractor that I add is Northrop Grumman, and in the past this company has been valued close to $350 or $375. You could argue maybe it was overvalued in 2018 or 2019, but once again, they do stock buybacks. I'll show you their fundamentals in a second, but this easily should get back to $350 in my opinion. When you look at their stock chart, they were depressed, downward trending, consolidating around this $300 mark. And because the other industrials and defense contractors have turned, look at that stock price go. It's gone from 295 to 323 in a month, which is an incredible price move. So it's probably gonna continue. So here's macro trends, and let's check out Northrop Grumman's, that's hard to say, NOC. Let's check out their revenue. Wow, increasing by a lot. Let's check out their net income. This is their profitability. Once again, solid. It's okay if it trades sideways. Let's look at their price ratios, and we can look at both price to earnings. What has it been valued at in the past? And we can see that its PE in 2017 hit 21, it hit 25, it's now only at 15, 16. You want this to be lower, so that's a good deal. Let's check price to free cash flow, and once again, it's been valued as high as 30, 31, 25, and it's currently only 17. We did not check the shares outstanding to prove that, once again, they've been doing stock buybacks, increasing or decreasing their share counts every year, which is what you always want to see. So the call contract that I bought expires August 20th. I'll definitely get rid of this before July. I spent $1,860 on it with the strike price of $320. Add the premium to the strike price. My break even on the call contract is $338. It's currently at $332, and I was saying this should easily get back to $350. So I'm definitely feeling confident about this call contract. The last defense contractor that I bought is Lockheed Martin, and Lockheed Martin before the pandemic was valued close to $440. Fell off a cliff. It looked like it was going to recover, and then as we approached the election, just was in a death cross event, hemorrhaging value. But once again, there's no news. There's nothing changing about any of these companies. These companies are exactly the same this year as they were last year. It's just investor sentiment, investor perception on them. So let's go ahead and look at the 6-month charts, and the lines have not lined up yet. So the 20 got above the 50, but the 50 is nowhere even near the 100 or the 200. So this is not a well-rested stock, but that's only because it fell so far. However, the industrials and the other defense contractors are turning around. But look at this. It was at 330 at the beginning of March, and it's already at 372. I don't know what percent that is, but that's got to be close to like a 30% move in a month. So let's check out Lockheed Martin's fundamentals. Let's go to revenue, and holy cow, that is huge revenue growth for Lockheed Martin. That is incredible. Let's go to net income. Once again, increasing. They're a very profitable company. Weren't affected by the pandemic at all. Let's go to shares outstanding. Yes, aggressive buybacks as they've been decreasing their shares over the last 15 years. Let's go to price ratios. And for PE, they've been valued, I guess they've been valued in the 13, 15, 16 range in the past, but it was shot up as high as 43, and it's currently at 15. So when you think about everything else in the market being overvalued, this should be higher relative to all the other stocks you can buy right now. Let's go to price to free cash flow. What has this company been valued at in the past? It's been as high as 29. Let's see here. We got a 38. But in a good year, 16, 17, and it's currently 15, 16. So pretty good fundamentals. The call contract that I purchased expires June 18th with a cost. It cost me $1,230. The strike price is $365. I bought this like 2 days ago, and it's already above the strike price. But my break even is the premium plus the strike price, so $377.31. I need it to get basically right here, which it probably will do in the next week or so. But I mean, this should go up another $50 a share. If it goes up another $50 a share, that's $5,000 that I'm making on this call contract, not even counting the extrinsic value. This just seems broken. So here's the wrap up, and these are the 13 call contracts that I have positions in. I'm still underwater with my stock in Apple, but that's the only position that I hold stock in. Now, the two kinds of call contracts, I've talked about this in previous videos, but these four, the price is currently down from its all-time high. I'm trying to hit a certain price before I exit the call contract because I think it'll probably just start trading sideways. However, more and more, I'm looking for stocks that are in a breakout or an uptrend, and I want to buy a call contract, get on that train, and then hold it until roughly a month before the contract expires, or it's evidence from the stock chart that the trend has halted. Usually, stocks will just start trading sideways for a month, and then you know it's probably no longer uptrending. There is a chance that it could reverse and it could start going down, but I like my chances in all these stocks that I'm holding because I think their fundamentals are good. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing if you haven't already. I talk a lot about finance and investing topics. If you have any questions or comments, I know I cover a lot of confusing information, especially with all the option plays. Check out my playlist on trading options if you actually want to understand what I'm doing in detail and be able to do it yourself potentially. Till the next video, take care.